Conceptual framework of accounting or IFRS framework. What is conceptual framework? Conceptual framework of accounting, usually known as IFRS framework, describes the basic concepts that underlie the preparation and presentation of financial statements for external users. The IFRS framework serves as a guide to the board in developing future IFRS and as a guide to resolving accounting issues that are not addressed directly in an international accounting standard or international financial reporting standard or interpretation. The scope of IFRS framework. The IFRS framework addresses the objective of financial reporting, the qualitative characteristics of useful financial information, the reporting entity, the definition, recognition, and measurement of the elements from which financial statements are constructed. Concepts of capital and capital maintenance. Objectives of financial reporting. The objectives of financial reporting is to provide financial information about the reporting entity that is useful to present and potential equity investors, lenders, and other creditors in their capacity as capital providers. Investors use that information to make decisions about buying, selling, and holding equity or debt instruments. Lenders and other creditors use that information to make decisions about providing or settling loans or other forms of credit. Financial reporting provides the following information: economic resources and claims, changes in economic resources and claims, financial performance reflected by past cash flows, changes in equity. The information about economic resources and claims provides the information to assess that entity's financial strengths and weakness, to assess liquidity and solvency, and its need and ability to obtain financing. A reporting entity's economic resources and claims are reported in the Statement of Financial Position. Financial reporting provides the following information regarding the changes in economic resources and claims. Users use this information in assessing the entity's past and future ability to generate net cash flows. The changes in an entity's economic resources and claims are presented in the Statement of Comprehensive Income. Now, we are going to discuss qualitative characteristics of useful financial information. Financial information is useful when it is relevant and represents faithfully what it purports to represent. The usefulness of financial information is enhanced if it is comparable, verifiable, timely, and understandable. Now we are going to discuss all the qualitative characteristics of useful financial information. Broadly, there are two types of qualitative characteristics: fundamental qualities, enhancing qualities. And under the fundamental qualities, there is needed relevance, faithful representation. And to be relevant, the useful financial information should have predictive value and confirmatory value. And to be faithful representation, Accounting information or financial information should be complete, neutral, and free from error. Enhancing qualities. The qualities of useful financial information will be enhanced if it is comparable, if it is verifiable, if it is timely and understandable. What is relevance? Relevant financial information is capable of making a difference in the decisions made by users. Financial information is capable of making a difference in decisions if it has predictive value, confirmatory value, or both. Predictive value. Financial information has predictive value if it has value as an input to predictive processes used by investors to form their own expectations about the future. Confirmatory value. Relevant information also helps users confirm or correct prior expectations. It has confirmatory value. What is faithful representation? Faithful representation means that the numbers and the descriptions match what really existed or happened. To be a faithful representation, information must be complete, neutral, and free from material error. Completeness means that all the information that is necessary for faithful representation is provided. Neutrality means that a company can't select information to favor one set of interested parties over another. An information item that is free from error will be a more accurate, faithful representation of a financial item. Now we're going to discuss the enhancing qualities of useful financial information. We can see comparability, verifiability, timeliness, understandability enhance the usefulness of information that is relevant and faithfully represented. Comparability. Information about a reporting entity is more useful if it can be compared with similar information about other entities and with similar information about the same entity for another period or another date. Verifiability. Verifiability occurs when independent measurers using the same methods obtain similar results. Timeliness. Timeliness means that information is available to decision makers in time to be capable of influencing their decisions. Understandability. Classifying, characterizing, and presenting information clearly and concisely makes it understandable. The cost constraint on useful financial information or reporting. Reporting financial information imposes cost, and those costs should be justified by the benefits of reporting that information. The elements of financial statements. Financial statements portray the financial effects of transactions and other events by grouping them into broad classes according to their economic characteristics. These broad classes are termed the elements of financial statements. The elements directly related to financial positions or balance sheet are assets, liabilities, equity. The elements directly related to performance, income statement, are income and expenses. The cash flow statement reflects both income statement elements and some changes in balance sheet elements. What is asset? An asset is a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow to the entity. What is liability? A liability is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from entity of resources embodying economic benefits. What is equity? Equity is the residual interest in the assets of the entity after deducting all its liabilities. What is income? Income is increases in economic benefits during the accounting period in the form of inflows or enhancement of assets or decreases of liabilities that result in increases in equity and other than those relating to contributions from equity participants. What is expense? Expenses are decreases in economic benefits during the accounting period in the form of outflows or depletion of assets or incurrences of liabilities that result in decreases in equity, other than those relating to distributions to equity participants. The definition of income encompasses both revenue and gains. What is revenue? Revenue arises in the course of the ordinary activities of an entity and is referred to by a variety of different names including sales, fees, interest, dividends, royalties, and rent. What is gains? Gains represent the other items that meet the definition of income and may or may not arise in the course of the ordinary activities of an entity. Gains represent increases in income, in economic benefits, and as such are no different in nature from revenue. Hence, they are not, they are not regarded as constituting a separate element in the IFRS framework. The definition of expenses encompasses losses as well as those expenses that arises in the course of the ordinary activities of the entity. Expenses that arises in the course of ordinary activities of the entity include, for example, cost of sales, wages, and depreciation. They usually take the form of an outflow or depletion of assets such as cash and cash equivalents, inventory, property, plant, and equipment. Losses represents other items that meet the definition of expenses and may or may not arise in the course of the ordinary activities of the entity. Losses represents decrease in economic benefits and as such they are no different in nature from other expenses. Measurement of the elements of financial statements. Measurement involves assigning monetary amounts at which the elements of the financial statements are to be recognized and reported. The IFRS framework acknowledges that a variety of measurement bases are used today to different degrees and in varying combination in financial statements, including historical cost, current cost, net realizable or settling value, present value, or discounted value. Historical cost is the measurement basis most commonly used today, but it is usually combined with other measurement bases. The IFRS framework doesn't include concepts or principles for selecting which measurement basis should be used for particular elements of financial statements or in a particular circumstances. Individual standards and interpretations do provide this guidance, however. Okay, all the previous slides based on ISB FASB joint project on conceptual framework. The next slides include assumptions, principles, and constraints taken from a USA book. Here, the ISB means International Accounting Standard Board, UK. The FASB means Financial Accounting Standard Board, USA. Recognition, measurement, and disclosure concepts. Assumptions. There are 5 assumptions: economic entity assumptions, going concern assumptions, monetary unit assumptions, periodicity assumptions, accrual assumptions. What are the principles? Measurement principles, revenue recognition principles, expense recognition principles, full disclosure principles. Constraints. There are two constraints: cost, materiality. Assumptions. What is economic entity assumptions? The economic entity assumptions means that economic activity can be identified with a particular unit of accountability. In other words, a company keeps its activities separate and distinct from its owner and any other business unit. What is going concern assumption? Most accounting methods rely on the going concern assumption that the company will have a long life. What is monetary unit assumption? The monetary unit assumption means that money is the common denominator of economic activity and provides an appropriate basis for accounting measurement and analysis. What is periodicity assumptions? The periodicity or time period assumption implies that a company can divide its economic activities into artificial time periods. These time periods vary, but the most common are monthly, quarterly, and yearly. What is accrual assumptions? Accrual basis accounting means that transactions that change a company's financial statements are recorded in the periods in which the events occur. Now we are going to discuss the principles. What is measurement principles? Cost principle and the fair value principle is used for measurement. What is cost principle? IFRS requires that companies account for and report many assets and liabilities on the basis of acquisition price. This is often referred to as the historical cost price or historical cost principle. Fair value principle. Fair value is defined as the amount for which an asset could be exchanged, a liability settled, or an equity instrument granted could be exchanged between knowledgeable, willing parties in an arm's length transaction. Fair value is therefore a market-based measure. What is revenue recognition? The revenue recognition principles indicates that revenue is to be recognized when it is probable that future economic benefits will flow to the company and reliable measurement of the amount of revenue is possible. Revenue is recognized in four periods. Some company recognize revenue during the production. A company can recognize revenue before it completes the job in certain long-term construction contracts. At the end of the production. At times, a company may recognize revenue after completion of the production cycle but before the sale takes place. An example is the mining of certain minerals. At the time of sale, it's very common to recognize the revenue at the time of sale. Upon receipt of cash. Receipt of cash is another basis for revenue recognition. Companies use the cash basis approach only when collection is uncertain at the time of sale. One form of the cash basis is the installment sales method. What is expense recognition method principles? Companies recognize expenses not when they pay wages or make a product, but when the work or service or the product actually contributes to revenue. By matching efforts, expenses with accomplishment, that means revenues, the expenses recognition principle is implemented in accordance with the definition of expenses, outflows or other using up of assets or incurring of liabilities. What is full disclosure principles? In deciding what information to report, companies follow the general practice of providing information that is of sufficient importance to influence the judgment and decisions of an informed user. What is expense recognition? Simply, we can see a diagram where we can see there are two types of cost: product cost and period cost. Product cost has a relationship with cost and revenue, but period cost has no any relationship with cost and revenue. Product cost is recognized in the period when they generate revenue. Then they are considered as a expense. But the period cost is considered expense when they incurred. Constraints. There are two types of constraints. Companies must consider the cost constraint. They must weigh the cost of providing the information against the benefits that can be derived from using it. Materiality constraints. The materiality constraints concerns an item's impact on a company's overall financial operations. An item is material if its inclusion or omission would influence or change the judgment of a reasonable person. Now, overall, we can see a diagram including all the objective, qualitative characteristics, elements, and assumption, principles, and constraints.